It all comes back to the DNA. The firms that know who they are will know who to be. You can learn a lot about an investment firm by listening to what they say. Alpco's Mainstream's AGM Originals, The DNA, Capturing Culture, is dedicated to capturing the DNA of a firm by listening to what they say. The first season of The DNA stars EQT, a global investment firm started in Stockholm in 1994 that has over 270 billion euros in AUM. I sat down for conversations with 9 EQT executives in Stockholm this past summer at their annual investor meeting. Each executive came from different parts of the firm and different parts of the world. Each had fascinating backgrounds and stories about how they ended up in private markets and working to build EQT. But there was a single through line threaded throughout all the discussions: the consistency and frequency that each executive talked about the firm's mission, vision, culture, and values. Episode 7 of Season 1, The DNA, stars William Vettorato, Managing Director, Head of Fund Strategy. William, welcome to the show.
Thank you. Thank you for having me.
Pleasure to have you. You have such a fascinating background when it comes to applying this deep structuring expertise and also working with evergreens, with one of the pioneers in the evergreen space, to bear as you think about creating new products and innovative products, particularly for the wealth channel. So I'm excited to get into this. First, I think it'd be great to start with your background, because I think that is so instructive in terms of your views on the evergreen space.
Well, I mean, I've joined private markets relatively late in my career. I've started on the trading floor on derivatives. I used to love mathematics, which I still love, and that was a one directional love. Mathematics didn't love me as much as I loved it. Started at Morgan Stanley many years ago on the trading floor, in a role which allowed me to practice my quantitative skill set within a business environment where you need to serve a market, but also serve a market putting clients first. So with a strong ethic and a strong competitive but ethic, let's say, approach. That, I think, was the way that it shaped me the most. Then being able to join a relatively different product class and asset class, which, to be honest with you, I think can serve very well, and at times much better investors, as you can find alpha in private markets much more than you can find in public markets. And with such a fascinating and ambitious targets of combining something which starts as illiquid. It's attractive because it's illiquid, but yet in a semi-liquid or, let's say, evergreen format. These were the things that attract me the most into this environment.
So I want to unpack the derivatives background, because it's really a structuring background. And I think evergreens in two contexts are actually very interesting when it comes to structuring. So one is the structure of evergreen is different. Two is the type of mentality one has to have when managing an evergreen structure may actually be more akin in some senses to public markets than private markets in some contexts. So I'd love to understand how you feel your background in derivatives and derivative structuring has helped inform how you think about the creation of evergreen structures.
Well, I think what I had to do when a structure and when working on derivatives was being very, very logical and quantitative in everything I was doing. So when you're pricing or when you're even designing complex payouts, you need to understand what the investor what could be appealing to the end investor, and make sure that you're very rigorous in the process of designing that product and pricing it, right? So I think that approach to me is ultimately what should drive a first-class offering of evergreen products out there. It's very important to have a rigorous approach. It's important to understand in which way you can serve your investor base, and I think in all this, a rigorous portfolio construction approach is ultimately what can distinguish a first-class offering from a more mediocre one.
What in your mind is a first-class offering in the evergreen space?
A first-class offering is, it's in general an offering that remains true to to the promise that he makes commercially to the investors. I think that's what we ultimately are called to serve, and it's easy to come up with very attractive commercial slogans. I think it's more difficult to calibrate a commercial promise which is attractive, but it's again realistically deliverable.
On that point, what do you think is the hardest part about creating the right evergreen structure and outcomes for investors?
Right here, right now, trying to ensure as much as you can that these products are sitting in the right place in the portfolio allocation of the end investor.
Well, you have the benefit of having experience of structuring evergreen funds and working at a firm that has been doing evergreens for a while before joining EQT Partners Group. What do you think you learned most from your time at Partners Group when it comes to thinking about evergreen funds?
A lot. First of all, that rigorous approach that I was mentioning to you, I think it's something that Partners Group was very focused on continuing. You have to think that, I joined there in 2017, and I would say up until 2021, the evergreen environment was very, very different from what it is today. I would say the Partners Group, which arguably invented evergreens back to 2007, 2008, the first vehicles, Partners Group was basically the core of the offering as far as 3-4 years ago, right? And in that environment, I think, they could have, demand was arguably not as mature as you have it nowadays, but was still very much present, and a smaller supply put them in a position that if they would have wanted to explode the AUM on evergreens very quickly, they could have probably done that. But I think one of the most important lessons learned is that evergreens are not here to. They're not. No business is a sprint. Every business is something that you should build with very realistic, let's say, assumption of probability to continue it over time, right? We at EQT talk about future-proofing businesses, and I think that longevity element, that credibility is key. But in particular in evergreens, you cannot be, trying to get immediate inflows and run away with it. So you need to have a very rigorous and solid offering.
How do you think about future-proofing evergreen structures?
So first, as I was mentioning before, I think it's important, education and proper communication and positioning. Future-proofing to me means reaching as much as possible and as consistently as possible that target return promise. And then a third element of future-proofing, in my opinion, is a stable offering. And when I say stable offering, I mean doing all you can to ensure your portfolio construction is as balanced as possible, to try and minimize the situation that no one wants, which is prolonged gating and negative, let's say, headline news risk.
Why are evergreens so expensive to launch and then manage?
Well, think of the management of a closed-end fund and of an evergreen. In a closed-end fund, you have a very specific fundraising activity, 18 months typically. The investment strategy hardly changes from one vintage to the other, and therefore there are lots of economies of scale when you're moving from one vintage to the other. Lots of things can be at large replicated versus what was done the previous time, and the focus is again the deal team when it comes to then deploy the fund. I look at it as filling a bucket. You have a certain amount. You want to deploy it ideally linearly over a couple of years, the investment period, but that's pretty much it. Evergreens require, first of all, an ongoing investment fundraising strategy, which means continuous efforts, which means events, which means addressing in very different shapes and forms a much more diverse investor base. And evergreens mean also a continuous deployment strategy where the investment strategy doesn't change neither, but you're constantly, in a very path-dependent way, constantly looking at what you are today as a function of what you've done yesterday and what you want to do tomorrow.
So that brings up a really
important point, which is the discipline that both the distribution team and the team managing the evergreen structure on the deal side has to deal with.
Totally.
How do you think about that aspect of things in terms of limiting inflows to make sure that you continue to meet return targets?
So in a context where there's excess liquidity generated by subscriptions or exits, I think someone who manages an evergreen has to make some tough choices. And if you look at evergreens, you would probably agree with me that the lower the liquidity sleeve level, the better. Because you don't want to go out to investors who want to have private market exposure and tell them that you're sitting on 20% of cash. But end of 2021 was a great example. After you deploy so much and after you have so much subscription, I think, and I was in that situation, partially by luck, but partially by design. Well, those are the moments when the industry should have no problems and say, now I sit on a bit more cash, which means my investment level goes a little bit lower. And that gains me time. I dilute you locally, but bear with me. And then it happens that in February 2022, unfortunately, the war in Ukraine starts, and you have a vehicle which has 20% cash, so you have the opportunity to, if any opportunities are coming up, can basically benefit from it.
What you're hitting on is a really important psychological element to all of this. And I think managing that psychological element for the end investors who are allocating to the evergreens, I think is really important to think about and talk about, which is generally when markets are good and people are having good returns and exits, that's when people want to invest more.
Yeah.
So they do, to your point. That's 21, right? Markets did well. There were a lot of exits. People wanted to put cash to work. They did, but new money in ground was at higher valuation. So the money that's going in is coming in at higher valuations that's being invested. Then you have 2022, markets take a hit, opportunity to buy, but then people either probably want to sell or they don't want to add more to their exposure in evergreen structures when maybe they probably should. How do you think about the psychological element of all of this? And then I think that relates to the educational element of all of this.
Well, I think that investors will react and will decide upon such a diverse set of parameters that it's very difficult to even at times understand what's going on. And every situation is so specific. We're talking about 2021, but March 2020 was another situation whereby many investors were happy to jump off evergreen funds to buy public equity, which was down 20%, and given the strong, let's say, support policies that were released every other week by the major economies, the story talks by itself. But back to your question, how do you do it? Well, I think the key is, again, to have a very diverse investor base. Because you'll always have situations where fast money in a certain region might redeem. You might have a situation where institutional investors that you think are very sticky and very stable might redeem altogether. But at the end of the day, they have specific dynamics which might affect them. And trigger redemptions even in a moment when you wouldn't expect. So diversification across investor base, I think, is key.
You mentioned institutional investors. The evergreen structures have generally tended to be products that have been built and suited for the wealth channel, but it doesn't mean institutions can't use them.
I think the axiom of choice should be defended in any place and any time. I see evergreens as a very useful tool, investment tool, when it comes to any sort of institutional investor, large or small scale, because the flexibility they give. Now, clearly, if I'm thinking the way a large Canadian or Asian or American pension scheme could work, I think, let's say, flexibility will still be useful, but you want to preserve an allocation which you control as close as possible. So I see for large institutional investors with that expertise, evergreens useful mainly from a flexibility, because of flexibility offering.
You mentioned one benefit of evergreens. In your mind, what are the biggest benefits of evergreen structures?
Well, I hate the word democratization, and I'm mentioning myself just because
You're not alone in that.
But in a way, and often it happens when a slogan sticks so well is because it's partially true. So I think providing access to an investment strategy like private capital in general to a wider set of investors, I think that is ultimately what I think evergreens are best accomplishing. And democratization, again, is not the right word. But I think it's fair to acknowledge that an asset class, which was a club deal for few in the late 80s and 90s, is now something that people can look at more actively. I think that's a benefit.
When you think about the intended goal of an evergreen structure, do you think that there's a best structure for evergreens? There's different types of structures. There's interval fund, there's tender funds, there's opcos, operating companies. Is there a best structure for evergreen funds?
From a pure investment perspective, I think the structure is not as important as the investment content, again, that you can put in it, and the ability to flexibly and as early as possible identify pressure points to position your portfolio. I feel there are very different ways to achieve the same target. Arguably, the more flexible you are, the more channels you have to deploy capital. Arguably, from a theoretical perspective, I would say the better position you will be. But then again, flexibility can take very different shapes and forms in different structures.
When you think about EQT's platform, what do you think about the platform plays to the strength of being able to create evergreen vehicles?
I don't want to sound arrogant in any case. I'm just commenting on other people's work, which is again the deal team. I think EQT is well recognized, especially when it comes to large institutional investors as a top house. When it comes to deploying capital, with a strong sectorial expertise, and therefore that ability to create value and to transform companies. We are a brand that I think is very well positioned to this regard. And this capability, you don't gain it overnight, you don't lose it overnight. An evergreen that can deliver that alpha to a wider set of investors, I think serves a purpose in the investment space.
You bring up something interesting that it's almost like the tail wags the dog in some senses, where now that you have the introduction of evergreen structures, adding additional capital to a firm's platform, giving them more investment firepower, right? You're adding new set of capital to come in and add to the platform. The tail wags the dog because it goes back around to the investment team, and I think in some senses it can open up the aperture of what the investment team can do. They can write bigger checks, they can invest in bigger companies. How do you think about that aspect of evergreens?
Well, I mentioned earlier that I think investment teams should just be focused on deploying capital, which I think to a large extent remains true. But you're very right in identifying this feedback effect. And again, if you think of the difference between drawdown structures, which are very static and very programmatic, versus evergreen vehicles, which naturally will fluctuate in deployment demand, very much in line with markets, then yes, you're right. The investment team should develop that capability of thinking in terms of, let's say, a solid deployment capital amount, which comes from, let's say, the more patient and steady drawdown structures, and evergreens, which ultimately will fluctuate in demand. There will be moments when there's excess demand, and therefore many subscriptions at 2021, where basically you get more, let's say, firepower, and other environments where evergreens are vehicles which might be generating less deployment capabilities. I think, again, in the context of a large investment organization, I think this ability to, let's say, be a bit more flexible ultimately will allow evergreens to coexist with drawdown structures, in which fraction depends firm by firm.
What worries you most about evergreen structures?
Well, I mean, as it is basically my profession now, I am only worried by systematic shocks. driven by a proliferation of offering, which might include less qualified players in the space. I mean, it's fair to say that once a business is florid, lots of people look into it, and that's to me the biggest risk. Or that's the thing that worries me the most. Making sure that investors make as an adequate due diligence as they can, and sharing with them, let's say, oversharing with them details and features, not just to show off the fact that I know about this market and this business, but most importantly to help them making their assessment.
In the coming years, say 5 or 10 years, do you think there'll be more or less evergreen funds?
I think there'll be less. There'll be less.
Why?
I think there'll be less because in 5 to 10 years, I think what I was mentioning before, target returns versus actual returns will be able to basically rank the funds out there. And every fund out there, I spoke with an Italian investor, a very, very savvy investor who told me that, and who discussing this environment, told me in the evergreen space is basically like looking at the start of a horse race when the gates lift and now everyone is pretty much. If you take a couple of examples like the outliers who have been on the industry for longer, you have a lot of evergreens which just launched, and everyone has a strong proposition. Everyone has an offering which is at least worth discussing. In 10 years' time, you'll see people who really managed to deliver on that and people who didn't. I don't want to sound like a negative, but I think there's a high chance that in 10 years' time, a fraction, which doesn't have to be like a small fraction, but let's say less than 100% will be delivering on their promises. And at that point, I think that investment decisions will be penalizing the ones who have not been able to deliver. That's I think like natural. Let's say.
How many winners do you think there'll be in the evergreen space? You think it'll just be really the biggest funds with the biggest platforms and brands?
My perception is that either directly or most likely through an intermediary, investors will appreciate the fact that you can build a diversified portfolio, but that diversified portfolio has to be founded on specific capabilities, specific investment capabilities. There's a lot of talking about moving from beta to alpha. I think in this space, this means making a very careful selection and identifying players who have a capability.
You mentioned diverse portfolio. Where my mind goes is model portfolios. How do you think the concept of model portfolios as it relates to evergreens will evolve? How do you think partnerships will be created? How do you think models will be constructed to include different types of evergreens?
Well, I think, as always, there has to be a proposition that makes sense for the investor, but it also has to work for the players implementing it. And I think you read a lot of these partnerships, which started a long time ago, I would say, between houses which are dominating the public market investments space, who have fantastic investment capabilities within that space, which is more to me beta or let's say core and satellite, but with a lot of core, and those houses see the opportunity to partner up with private equity or private market providers who can combine together, offer in one solution the two worlds. And there, model portfolios are key because you might want to modulate, and typically you have 3 offerings.
Do you think there's going to be a race to the bottom on fees eventually for evergreen funds as there was for traditional asset management products?
So when I was on the trading floor at Morgan Stanley, I had the opportunity to deal on the other side with the best hedge funds, macro hedge funds, quantitative hedge funds that you can think of. And on the other side, I pride myself having studied mathematics in a very good school. But on the other side, there were real geniuses, right? So human capital, which was very, 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 very strong. Those hedge funds had at times very inconsistent performance, despite the great talent on their ranks. And And their performance fees were not very different from the performance fee that private markets or private equity charges. When you look at private equity, without offending our dear colleagues, I think that it's hard to find people with a PhD in astrophysics and with fantastic calculus capabilities, but their ability when it comes to investing can deliver alpha more consistently. There, the fees that you pay, to me, as an investor, makes much more sense. So back to your question, the difference will be dictated, in my opinion, by the performance that houses deliver. If you really can deliver what people now talk, everyone talks about it, value creation, ability to transform a business and reposition that business organically or even inorganically, but with a strong sectoral expertise, then you should be paid for it, and you will be paid for it, because by definition you'll be able to deliver consistently alpha. If your promises are empty, your track record will be weaker, and you'll be out of market.
How do you think about the concept of alpha and beta as it relates to evergreens? Because of the structural nature of evergreens, they compound. Invested dollars are put to work right away. So, there's been a lot of industry literature around you can generate similar multiple on invested capital over a 10-year period in an evergreen structure as you can in a closed-end fund, talking private equity as an example. But the IRRs can be lower in an evergreen structure because of the structural nature of the evergreen versus the closed-end. Do you think that the industry is missing out on alpha by doing that? Or is that something different than what you think?
That's a tough question. The way that I talk about alpha is it's again related to the ultimate ability to really understand the business and transform it. There is alpha in, I would say, or let's say skill set in managing evergreens properly. That compounding element that you mentioned about is something that doesn't happen by magic. That compounding element is a function of a portfolio which is well oiled, and that in a very as uniform way as possible can benefit from distributions within the portfolio, subscriptions and redemptions in steady state, all very oiled. If you have a situation where you're gated for a prolonged period of time, that compounding magic that people talk about stops, because you will be using all the liquidity you get to pay out redemption till the maximum you can. You'll be concerned in liquidating or preserving that little liquidity, and by definition, you'll be deploying less in new vintages. So again, it goes back to a very disciplined and rigorous way of putting together these portfolios.
How much of what you just said around making sure you're managing the fund properly, managing liquidity, redemptions, new investments, coming down to educating LPs? Because if there's a school of thought that private markets have been illiquid for a reason, and you could argue that evergreen structures, while they provide liquidity, and that's important for investors at times, right? They have a life event, they need some liquidity, they need to rebalance portfolio, fine. But there's a school of thought where people should just invest in these evergreens and let it compound. And that shouldn't be a place where they should take liquidity from, unless they really need it. So how do you think about that element of educating investors so they understand the intent of these products?
Yeah, that's very good. That's very good. I think the investing in evergreens and keeping it there as an asset in your portfolio and riding it for long is something that everyone wishes when it comes to offering evergreen. But in reality, as you just mentioned, liquidity events will dictate necessities to redeem. Often we forget about the fact that even if you're performing very well, investor might want to redeem to crystallize some of that gain. So I think it doesn't even have to go down to the liquidity event or to the life event. You might want to just see that cash transformed. So the education to the LPs, I think, or to the investors at large, again, has to contextualize this offering as the best way we have today. And if you're overly concerned about the liquidity element, that's probably you're not the right investor in these vehicles.
Feels like this topic will be an evergreen question for quite some time,
Yeah.
but a really important one to unpack. William, this has been a fantastic conversation.
Likewise.
Thank you for listening to this episode of The DNA, Capturing Culture. You can stream all the episodes on your YouTube channel at altgoesmainstream AGM, or read about the episode at my Substack at altgoesmainstream.substack.com. And of course, special thank you to EQT and the executives that shared their stories and perspectives. Thanks a lot, and have a great day.